Hello and welcome to this new blog post where I want to talk about sustainability and ESG reporting and how to fix it. And this is the first part of a multi-part series, so stay tuned and follow if you want to learn more about ESG reporting and the problems. And here a short disclaimer, so what I'm saying here is my own opinion. And let's get started. So why do I come up with a topic about ESG reporting? Well, the trigger for me was basically a presentation of Professor Kaplan and Ramana at the Accounting for Sustainability Summit that takes place usually in autumn every year. And this year they make a presentation of a paper that they called How to Fix ESG Reporting. So I took the same title for this blog post here. And what they are saying is basically there are some problems with the ESG reporting, and because of that they established an institute that helps companies and interested parties to implement their so-called e-liability approach. So let's focus first on the problem. So what is the problem? They say, okay, the current way how we measure greenhouse gas emissions, according to the greenhouse gas protocol, that's not reliable. That's something is wrong with that. Why? Well, they say, hey, there are problems, especially with the Scope 3 emissions. I put you here on the left hand side a quote from the Greenhouse Gas Protocol website, and what they heavily criticize is what I highlighted here you in yellow color. It's basically that they say, hey, Scope 3 emissions, they occur from sources not owned or controlled by the company, and the use of products and services by our customers. And then the question is, of course, how can I measure and take responsibility for something that I do not own or control? So I do not know what my customers are actually doing with this thing. So, and here's some funny examples that you can find on YouTube or in the internet. First thing is, and I will not play this video, is a customer basically just destroying things with his car. I mean, they just use our products and destroy them, and that's totally out of control what we are doing. Next thing, I will also not play that, you can find it on YouTube. Somebody buys a new iPhone and just destroys it. And these are just things that are outside of the control. And then the question is, how can we really measure what's going on here? And another problem that I'd like to highlight here is the scopes. So for most companies, scope 1 and 2, so direct emissions, so let's go back. Direct emissions only account for the relative smallest part of their emissions. And the biggest part is scope 3, the indirect ones. And if I relate this to an accounting idiom, then this sounds like a bit cooking the books. So if you have a lot of latitude how to measure and include what to include in scope 3 emissions, then you can really manipulate things. And that's what they criticize in their paper. If 2/3 or more are scope 3 emissions, and if you use averages and estimates to report them, then you can basically do whatever you want. You can cook the books or cook the accounts. That's what they say. Here are some quotes from different sources. So they say, hey, here scope 3 data, they are not really good for strategic decision making. They can be misleading. They can lead to a misallocation of capital because of the measurement problems. Then, of course, it's outside of the control of our company. Then they say here, it's difficult to track and it can result in double counting. And then they say here, and try to relate it to finance and accounting. Imagine a financial accounting standard that allows a company to use industry average raw material cost rather than actual invoiced raw material cost for reporting and measurement. And that's the big problem with the whole greenhouse gas protocol and how we are measuring these things. It's just taking averages, taking different liabilities, and then converting the emissions into greenhouse gas emissions. So that's the big problem, the measurement. And what they are saying is, hey, these concepts, on the one hand side, the top-down approach from the greenhouse gas protocol, and what we see in companies, the bottom-up approach, and the business processes that are illustrated here, they don't match, they don't go together very well. Why? For example, if you take electricity scope 2 here, it is everywhere. And therefore the existing systems and how we measure things, this is really not very good. Okay, so what solution do they suggest? And here's a video. You can find this on the eLiability Institute that I mentioned before, and on YouTube. I will not play it here because I make a graphic to illustrate you the main points of their idea and their concept. So what is the main idea? And they base it on a company that is producing cars or vehicles, and to produce this car or vehicles you need iron ore, so a mining company. Then things are shipped, then it's produced, it goes to sellers, and then finally arrives at the customer. And the idea is the following. So they say, okay, when you mine this iron ore, let's say you have a CO2 emission of 5 tons of CO2. That's what happens in this company. Okay, now they say, okay, we shift it over. We do like a kind of value-added tax system. So this company here, they shift the 5 ton of CO2 to the next one in the chain. Then they have an additional 2 tons of CO2 emissions. So 5 and 2 is then shifted on to our company. And we continue. We add 3 tons, we shift it on, and then finally at the customer, if you add up all these numbers, in the final product we have 11 tons of CO2 emissions. And that's what you can report. But you can report it at every single stage in this value chain. So if you're at our company, you can say, okay, when the product leaves our company, we have 10 tons of CO2 emissions included in our product. The 1 ton that happens here from a merchant, that's outside of our control. We just don't know, and we cannot even estimate it. Therefore they say, okay, what is reliable, what is measurable is this one. Okay, now what are the advantages of this approach? Well, it's simple, accurate, verifiable. It's real time because this thing is based on accounting principles. You do accounting here, and with every accounting entry you can directly measure what's going on. There's no double counting of emissions that can happen with Scope 3 emissions. And the main advantage, what they say, is it's based on accounting principles. And that's also what I mentioned as disadvantage, because it needs accounting knowledge and know-how, and many people are just scared with accounting and these things. So now let's have a look at how does this eLiability approach work in detail. And now, if you're not an accountant, just relax and have a look, because we will go through a couple of accounting entries. So I will illustrate the following for a trading company that has no production, to keep it easy. In the next post we will have a look at the production company and more complex cases. But for now we keep it simple. Then we just buy goods and buy energy. I look only at 2 periods, so 2 months, 2 years, whatever you count, and we will not make a T account illustration, so not really accounting. And we look only at 2 companies in the value chain, at our company and at our customer, to keep it as simple as possible. Now let's start, okay? So first thing, and let me highlight that with my laser pointer. So when you purchase trading goods, you or my company, we buy something, we buy an item that is raw materials, or it can be an item, it's inventory. In my example, we buy 1,000 pieces, $10 or 10 euro is the price, gives an inventory value of 10,000. The credit, so here's debit, here's credit. The credit is accounts payable 10,000. That's the pure accounting entry, what every company is doing anyway. Now comes the eLiability, and they say, okay, if I know how much CO2 is included in these items that I buy, and here I just imagine for this example, I just take 5,000 kilos. That then I post that E liability. Now let's continue. I purchase energy. The accounting entry is the white one. Electricity expense, debit, accounts payable, credit. In my example, 2,000 euros. And then they have a second line where they post the E liability, 1,000 kilo in this example. It's just a fictitious number. Yeah? And then they sell something. Yeah? The accounting entry is accounts receivable, debit, sales, revenue, credit. In my example, 40,000 euros. And then we have the COGS, cost of goods sold, and the inventory that reduces our inventory or our stock, 8,000. And of course, also the E liability is reduced. Why? Because part of the liability that we account here is rolled over to our customer. I put it here in a kind of overview. So first we purchase something, materials, then electricity, and then 80%, which is just 1,000 pieces, this is what we buy, 800 what we sell, so 80% of our CO2 emissions are shifted over to our customer. What remains in our inventory is just a difference, so 1,200 kilos, and because we have 200 pieces on stock, if you take 1,200 divided by 200, then you can say, okay, the items that I have on stock have a CO2 footprint of 6 kilo per item. That's what you can calculate with every standard finance and accounting tool. You don't need something special. Yeah? Now, how does it look at our customer? Yeah? So when the customer buys the 800 pieces from us, he posts inventory or item against accounts payable. And then he gets the 4,800 kilo from us as a E liability. That's what he gets from us. Then he purchases also energy. So we assume he has a warehouse. Yeah? So electricity expense, debit, accounts payable, credit, and so on. Same principle, and then he sells things. And this time I say, okay, what he buys is what he sells. So there is nothing left on stock. So if you look at the E liability, he purchases E liabilities, 4,800 kilos of CO2, 800 from electricity, and then he sells everything. So on stock is 0. Now let's have a look at the second period. Again, same example, I buy a raw material, 2,000 pieces, I have here a E liability, also just an assumed number. I buy electricity, same as in the first period, but with a different quantity and greenhouse gas emission, and then I sell it. Yeah, but this time I sell only 1,500 pieces. Now if I make the same calculation again, here's the 1,200 kilograms from the previous period, yeah, because now we are in period 2. I buy something and I sell something. And now I say, okay, I break down of what is left, 3,950 kilo, I can break it down by what I purchased in the first and second period, leaving me 700 pieces on stock. Why 700? 200 from first period, and here in the second period 500, so 700 pieces, and that's the total CO2 emissions. If I divide it, I have 5.6 kilo. How does it look at my customer side? Well, he purchases our products and he gets our CO2 emissions. That's from us. Then again, he purchases electricity and he sells something. This time, he does not sell everything. He sells only 1,000 pieces. Now, if I make this calculation, from first period, he has 0 kilos as a beginning balance. Why? Because he sold everything in the first period. But now in the second period, he has something on stock, 3,000 kilo in my example. Here's the breakdown. And with 3,000 kilo and 500 pieces on stock, you can say 606 kilo CO2 emissions per item is what he has as a CO2 footprint. Now a different illustration. Here on top, I have our company. Here's period 1, here's period 2. And these are just the graphics that I highlighted here. So the ending balance in period 1 is the beginning balance in period 2. The ending balance in period 2 will be then the beginning balance of period 3 and so on. So this is a pure accounting system just applied to CO2 emissions. And for our customer, it will look like this. In the first period, 0 kilos is the beginning balance, ending balance 3,000 kilo. Okay, and here's the illustration and the shift over what the e-liability concept is doing. So we sell something to our customer and the CO2 emissions from us are shifted over to our customer in the first period and also in the second period. So here in our company it goes out, for our customer it goes in. Again, here I just highlight you the approach, how this works. This is the shift that I try to explain, and this is purely accounting principle, basic accounting. And of course we just focused on 2 companies, but in reality there are more companies involved. Now, second example, and here I'm not doing the full accounting again, I just highlight you the results again for 2 companies. And what I did is I compared the different inventory accounting methods. So in the first example I used a LIFO valuation. So in my company I had a 1,200 beginning balance. In the second period came 9,000 and 2,000 kilo on top, and then I used the LIFO principle to calculate what is going out. Now what you can see is, if you use a different principle, the E-liability at the end of the period is different. And also the CO2 footprint per item that you have on stock is different. So what is the message of that? Well, it depends on what kind of method you use that has an influence on your CO2 footprint if you're buying and selling products. So what you need is really an accounting system, an inventory valuation system. That's what is needed, and every ERP system has that. Okay, so here's some important questions and answers, and you can find them on the website from the E-Liability Institute. There are, I think, 50 questions. I just highlighted the important ones. So first thing, how can you plug this into existing systems? And answer is easy. Use what you have. Use your ERP systems. Second question is, how does it sync with different standards? So you might have heard from my previous post and from the media, CSRD reporting or GRI reporting, SASB. All of these are accounting standards that measure scope 1, 2, 3 emissions. This kind of E-liability approach is different because we focus only on the emissions that we have under our control. Now, next thing, how does this work if not every company is applying this immediately? And the answer is, of course, it's difficult. In theory, every company should implement this principle immediately. Why? Because we as our company, if we purchase electricity, we need to know what is the CO2 footprint of the electricity we buy. Our customer needs to know what is the CO2 footprint of the products he buys. And if we are not implementing this at the same time, then it's difficult. But they have a couple of studies where they show how to implement this in practice. So it's not a theoretical concept, but they really demonstrate this, how to do it with companies in the automotive sector, in the electricity sector, and so on. They have a couple of studies where they show how to implement this. Of course, it's not perfect at the beginning. Not everybody is doing that, but because many companies are already using sustainability accounting, you can get this data, and they show you. I will show you a link later on how it works. Okay. Now, next question is, what should you include? And they say here only elements, only emissions that are under our control are accounted for, nothing else. Then, what about downstream emissions? And here they say, hey, that's not our responsibility. Remember the examples that I showed you with the pictures in the beginning, where customers destroy an iPhone or something, or burn something, That's not under our control. So how can we account for it? We cannot. That's what they say. Now, as a summary and outlook, I hope you got this concept, what this E-liability is doing, and how we can use existing ERP and accounting systems to implement the approach. It's a very simple system. It's verifiable and accurate because we don't use estimates, we use real data. There's no double counting in emissions, and it works like a value-added tax system. And it gives you real-time data and insights. With every accounting entry, with every invoice that you record in your system, you can make this kind of calculation. Now, the key thing, of course, is what I mentioned. You need the CO2 product carbon footprint from your previous partner in value chains. Is it realistic to get this? My my answer is yes. Why? Have a look at some studies. Look at the eLiability Institute. There are all these papers published, and have a look at how they implemented this in practice. Now, next post, I will focus on a much more complex example, where I focus on a production company that also has fixed assets and other things. And we want to have a look at how we can implement this concept into a business application system. But for today, I just wanted to introduce you the approach, how this can be done, how CO2 emissions can be measured in a different, more reliable way, especially the Scope 3 emissions. And I hope you understood this concept, the way how they measure it. If not, just post me something in the comment section or send me an email. So thanks again for watching and listening, and then looking forward to seeing you in the next part.